get us started. Welcome everyone to today's teach-in on how money flows through a cooperative. I am going to be doing some of this presentation. My name is Ricardo Nuñez. I work at the Sustainable Economies Law Center. I am the Director of Economic Democracy, and I've been working at the Law Center for about 8.5 years. And something I'm excited about is just all of the momentum around worker cooperatives and alternative ways of rebuilding the economy that is rooted in racial and economic justice. So that's a really exciting thing that I'm seeing. And I'll ask Greg to introduce himself.
Hey, greetings everyone. My name is Gregory Jackson, or Greg also. Hope you can hear me. Let me know if it's a little too low. I'm a staff attorney at Sustainable Economies Law Center and also co-founder of Repaired Nations. I think Ricardo and I share that deep commitment to fixing the problems of the past. I focus more autonomy and sustainability. In cooperatives and housing. I'm really excited to be here, and thank you for joining.
Thank you, Greg. And we are doing this presentation in collaboration and actually sponsored by and supported by the city of Berkeley. And so later today, we're going to be hearing from Kieran Slaughter from the city of Berkeley. But Kieran, you want to introduce yourself really quickly?
Sure, might as well. I'm Kieran Slaughter. I am with the City of Berkeley's Office of Economic Development, Chief Community Development Officer. I manage our city's revolving loan fund, which makes low interest rate small business loans to Berkeley-based businesses. And it's exciting to be here, and I look forward to the presentation.
Nice, thanks, Kieran. Yeah, so before we get started, just wanted to thank the city of Berkeley for supporting this work, supporting the growth of the worker cooperative sector and employee ownership. We believe at the Sustainable Economies Law Center, it's an incredibly powerful tool to root the economies in the communities that are served by them and that the communities are doing the work through. And also want to thank all of the advocates who showed up at Berkeley City Council's council meetings to advocate for the passage of this budget allocation to support worker cooperatives. And Kieran's going to be talking a little bit more about that later today. So, cooperative capital and the law. We're going to be talking about how money flows through a cooperative. And when I do these types of trainings, I like to ground it in how the existing models of how money flows through our economy serves particular communities and particular people over others. And so just as an example of that, we saw through this COVID pandemic, wealthy corporations and the wealthiest 1% or 0.1% have their wealth increased by trillions of dollars. In fact, the combined wealth of all US billionaires increased by $1.1 trillion between March of 2020, when the pandemic started, and this January, from about $2.9 trillion to over $4 trillion. And over that same period of time, we had low wage workers having the highest increase of job loss in our communities. People have talked about hundreds of thousands, over 1 million people have lost their jobs. And it's not only that it's low wage workers, it's that it's directly impacting people of color, and that people of color were making up a large proportion of those jobs that were lost. And so it's not only that we have this concentration of wealth flowing to the wealthiest in our country, it's that the marginalized and already folks who are trying to cling on and take care of themselves are getting pushed out. And so this pandemic has really exacerbated the existing inequalities of our system. And so what we're hoping to do is to create a different type of system, to create a different way for money to flow through our communities. And so that's what our work at the Sustainable Economies Law Center is all about. We're here to cultivate a new legal landscape that supports community resilience and grassroots economic empowerment. And we sometimes like to talk about our 4 strategies as education, research, advice, and advocacy for just and resilient economies. And other times we like to just reformulate what we're doing. So we're looking at the economy. How do we create sustainable systems to meet everybody's needs? And so then how do we create laws and policy tools that people can use to shape their own communities? And also those 2 things are in relationship to culture. And so how do we set an intention and start to build a visionary narrative and help support building movements that can really start to shift the culture and how we view ourselves in relation to each other and how we see our relationship to the economy and to the law. And before I go into my presentation, I just want to give a short disclaimer that I am not an attorney. I'm a legal apprentice. So in California, you can still become an attorney without going to law school. I'll be taking the bar this summer. So fingers crossed, I'll be an attorney by the end of this year. But for now, this is not legal advice. This is just legal information. So a short introduction into how money flows through cooperative business. I'll be going over that. Greg is going to be talking about what are some of the tax and accounting issues in a cooperative and what cooperative specific tax benefits exist and how can your cooperative take advantage of them. I'll be talking a little bit about that too. And then we're going to be talking about where can you find more resources. Today's introduction is just that. It is just an introduction. So as we're using terminology, as we are going through the different tax categories, it might feel like a lot falling on you, but don't worry, we got you. We have resources on our website, cooplaw.org, has lots of manuals on our website, the SELC.org, so you can go to these websites, download resources that are more fleshed out and can give you a fuller explanation of what we're talking about today. Today, we're just trying to set the conversation to get you to understand what questions to be asking yourself and how to navigate, to start to navigate for your cooperative or cooperative you might be working with, how they should be thinking about how money flows through their cooperative. So that's what I'm going to be talking about. It's pretty amazing. To start off, just some grounding. Cooperatives can be many things to different people. So this is supposed to be an elephant here, and all the different people are touching the different parts of the elephant. If you've heard that proverb of the blind men touching the elephant, and each part of that elephant, they're saying, it's this, it's that. So it's the same thing with cooperatives. To some, cooperatives is a tax category under Subchapter T, which is what we're going to be talking about today. To others, a cooperative is a type of corporation that you can form under state law. So maybe sometimes attorneys will say only cooperatives formed under the cooperative corporation law is a cooperative. To others, regardless of whether it's a type of legal entity or a tax status, it's to others, it's just an organization that adheres to certain principles of democracy, equity, and inclusivity. Yeah, sorry. So today, we're going to be talking about cooperatives in that sort of last space, where we're going to be talking about cooperatives that operate cooperatively. And I'll get into that in a second. Another piece of foundational sort of information is that we're going to be talking about some tax benefits for cooperatives. And to understand why it's a tax benefit for cooperatives, we have to start off with what the existing tax system looks like for a typical corporation. So when forming a business, cooperative business, most people we work with either incorporate as a cooperative corporation or some type of corporation or a limited liability company. So when corporations bring in money, they get the corporation itself is a legal person. And so that legal person, the corporation, is taxed. And then when the money goes to the individuals, whether it's in wages or in profit distribution, it's taxed again. So there's double taxation on typical corporations. And the high level for us today is that if you are operating cooperatively in a cooperative enterprise, that you can get a special tax benefit for operating cooperatively. And instead of getting taxed twice, you only get taxed once. And so you, as the member of a cooperative, can actually see more of that money, that income that you're making. So what does it mean to be operating cooperatively? So there was a very famous court case called the Puget Sound plywood case that really set out the foundations of or the guiding principles for what it means to be operating cooperatively. So the first principle is subordination of capital. And so what that means is that instead of a typical corporation where the legal purpose of that corporation is to maximize shareholder return, so to try to use all of the power of the corporation to make the most money for shareholders, that in a cooperative, it's actually to meet members' needs. And so instead of capital being the supreme thing, we subordinate capital and make it meet the needs of the members. So that's the first principle. The second is that the enterprise is democratically controlled by its members. And the third is that any leftover money in what we call cooperative taxation surplus, that the surplus, that leftover money at the end of a year, is given back to the worker members in proportion to their active participation in the cooperative. So what value did that person actively give to the cooperative during that year? And that's the in proportion that they're going to get back. A couple more terms just to set the groundwork. We're talking about surplus, we're talking about patronage, talking about profits. So I just wanted to distinguish these things because when we're talking about taxes and how money flows through a cooperative, it's important to know these distinctions. So the first is profits. Profits is the net income after expenses during a fiscal year attributable to non-member labor. So even in worker cooperatives, whether it's a candidate who's just acting like a typical employee or somebody who's never maybe going to become a worker member, maybe they're only temporarily there, that any of the profits or any of the additional revenue minus expenses at the end of the year that's left attributable to the labor of those non-members, that's what we call profits. And that's why sometimes you'll hear profit is theft, because it's what is taken from those people who don't have the ownership and control over their workplace. So profits is different than surplus, which is the net income after expenses attributable to member labor. So if you're a member of a worker cooperative and you are actively participating in it, any of that leftover income after expenses that's attributable to your labor, and that's surplus. And that's the stuff that we can use to get a tax deduction for the cooperative to save more money so that members can receive more of that income. And the patronage dividend is a distribution that the cooperative pays its members. It's sort of like the annual bonus. So that's what we call that, that benefit at the end of the year. The patronage dividend is that allocation of surplus. And so what does this look like in practice? So cooperative ownership structures, cooperatives are a lot of times when the workers are working, they're getting paid their wages, just like anybody is doing when they're working as workers in a workplace. So that's what they're going to get. But they're also, as members of the cooperative, they're going to have member capital accounts. So the member capital accounts is where a member has their member equity. So when you join a cooperative, you buy into that cooperative. And sometimes each cooperative gets to define how much that member buy-in amount is. Some cooperatives have it very low. It could be $50 or $100 or something like this. But other cooperatives decide that we want a really high or a higher equity buy-in. 5,000, something like this. And so each cooperative gets to decide what that is. But when you buy in, that starts your member capital account. Then you're going to have in that capital account retained patronage, which is when we do those patronage dividends, some of it is paid to people in cash, and some of it is you get like an IOU from the cooperative to say, we're going to hold this money for now, and you're going to get this money later, but we're on the books. We're going to put this money into your member capital account. And I'm going to go through a little story to show you how this works. So I'm just setting the definitions right now. The patronage is your ownership dividend. So that's the annual surplus that's given to the members as owners. It's the patronage distribution, and part of it is paid in cash, like I said. Part of it is retained in member capital accounts. So in the law, it's actually mandated that you pay out 20%, at least 20% in cash every year. And that's because you're not going to have to pay taxes on the entity level, but you as an individual, you're going to have to pay income tax on it. So the government wants to make sure that you get at least 20% of your patronage dividend in cash every year so that you can at least pay the taxes on the full amount of your patronage dividend for that year. Okay, so how are we going to do this? Let's do a little story. I've been watching Schitt's Creek lately, so we're going to use them as our characters to show you how money flows through a cooperative. So all of our friends on Schitt's Creek, the family of the Roses, and Stevie, the employee at the hotel, they all decided they're going to buy in and they're going to change this their motel to a cooperative. And so each person, they buy in at $10,000 each. So how does money actually flow through a cooperative? So, and how do we determine surplus versus profit? So let's say that the motel does okay. They bring in 650,000. Their costs and expenses over that year was 539,000, and so left over they have $111,000 that year of net income. So how are they going to distribute this amongst themselves? Stevie, the hotel employee, generated a certain amount of income, and so that is, we're going to set that aside because Stevie is not yet a member of the cooperative. She's a candidate, whereas the Roses, they're all the members of the cooperative, the family members. And so we're going to set that aside. Then the surplus that's generated by the Rose family, that was $100,000, is attributed to their labor as members. And so what do we do with that surplus? How are we going to move that money around to the different people? So we have $100,000 in surplus, and the Roses, as the cooperative, when they were writing their bylaws, they decided, you know what, every year before we get any of the surplus, we're going to put aside 25% of the surplus into a collective account for the cooperative, because we want to build the collective account of the cooperative so that we can use it as both operating capital, but also investments into the cooperative itself. And that's written in your bylaws and decided before any of this happens. So that's something that you'll want to talk about with your cooperative members, is how much you would want to set aside before that surplus is distributed to members. So we have $75,000 left of patronage. And so the cooperative has decided, you know what, even though the government says we have to give 20% out, we're going to give 50% out in cash, and we're going to keep 50% in the cooperative and give everybody IOUs and put that money into the internal capital account. So the cash payment of 50% of that 75,000 is 37,500, and then the other half is going into retained patronage, the member capital accounts in their cooperative. And so when they split that out, a lot of cooperatives typically will do it on the basis of how many hours you worked. So the proportion of hours that you worked versus other people in your cooperative. And so here we can see how the money was split between Stevie and Johnny and David and Moira and Alexis. And so the retained patronage that's in the member capital accounts will be paid out later. So some cooperatives, they'll write into their bylaws that we will start repaying or paying out the member capital accounts after the money has been in the cooperative for 3 years. And that way you don't have these retained patronage member capital accounts ballooning year over year, so that if somebody leaves or they want their money, it's not as big of a hit on the cooperative itself. And so you start to pay out those member capital accounts over time, so it doesn't balloon and become too much of a liability for the cooperative. So let's look at Alexis's her individual member capital account. So remember, every member of a cooperative has an initial buy-in amount. That's their equity stake in the cooperative. So that's 10,000. That's going to stay in Alexis's member capital account for her entire life that she's a member of the cooperative. So after year 1, Alexis receives $6,000 in retained patronage. So now her member capital account is $16,000. So we'll go to the end of year 2. So at the end of year 2, she still has that $10,000 in her member capital account, plus the $6,000 from the first year. And then in year 2, she got $4,000 in retained patronage. So her total member dividend was $8,000 for year 2. So she got half in cash and half went into her member capital account. Now, Schitt's Creek Motel decided that instead of waiting multiple years to start to pay back the member capital account, they were just going to pay the previous year's member capital retained patronage out to the members the following year. So she's going to get that first year's retained patronage in the second year, and that second year's retained patronage is going to stay in her member capital account. So after year 3, she has that $4,000 in her capital account. Year 3, they didn't have as good of a year. She only had $1,000 as her half of the retained patronage. And so she gets paid out that year 2 and so on. So that's how this model or Schitt's Creek Motel decided they wanted to distribute their member capital accounts to their members themselves. And so what are the benefits of some of this this way that money is flowing through these cooperatives differently? So like I said, it avoids double taxation, which means that the patronage is not subject to the corporate income tax. It's also a means of retaining cash in the cooperative, so it doesn't discourage longer term planning because you can put that money aside from the retained patronage into the cooperative as operating capital, so you can be using it for your business. And then third, it's it can be a savings mechanism for members. So it can sort of be like a little bit of piggy bank for the members themselves to grow year over year and know that they have that stability. So then how does this actually implicate you as a member in what decisions you make? So it does get gets a little complicated in cooperatives because you're actually wearing different hats at different times. And so for cooperatives, it's really useful for them to know which hat they're wearing at what time. So what if the question about do we raise wages, when that question comes up, what are the different hats that you're wearing? What might they be telling you? So maybe as a worker, you're like, I need the cash now. I want to increase my wages. So let's increase our wages and so that I can have more cash on hand as we're moving through the year. But maybe if you have your owner hat on, you're like, wait a second, why don't we lower wages? We can have more patronage at the end of the year. That patronage is going to be taxed a lot less than the taxes on my W-2s as an employee. And so I'll actually have a lot more money. So why don't I don't need the money as much during the year, but and so let's lower the wages so that I can actually get more money at the end of the year. And then maybe you have a third hat on and you're thinking about it like a manager. You're like, okay, well, we need to save for new equipment. So actually, instead of raising our wages or lowering our wages so that we can get more patronage, let's take some more of that money and set it aside because we need to invest in our cooperative. So those are just like a few ways of how you or somebody you're working with who's a member of a worker cooperative, how this can get complicated, but also be a really empowering vehicle for people to understand their voice and their power and benefit from the labor that they're contributing in a business in a totally different way than in a conventional business. So that's my time. I'm going to see if there's some questions, maybe take a minute to answer any questions, and then we'll have a break. Tia, is there any?
Yes, we got a fact check. Stevie is the owner. Come on now, gotta support fem-owned businesses. Or not a fact check, but a suggestion. Jackie asked, are you using IOU interchangeably with notices of allocation?
Yes, so thank you. That is, that was from Jacqueline?
Yes.
Okay. Oh yeah. What's up, Jacqueline? Yes, I'm using that interchangeably. So when you start to get a little bit more technical, there's these things called written notices of allocation. That's what you're going to receive as a cooperative member for the retained patronage that you're in. So I am using that interchangeably, but the official term is written notice of allocation. Yeah.
Good to know. Daniel asked, how do cooperatives generally identify at what point you hit a surplus?
So it's the end of each taxable year is when you're defining surplus versus profits and doing all of this accounting. Greg is going to go into a little bit more with I'm talking from more of a perspective of a corporation that has annual taxes and is treated like a person. Whereas LLCs, you might have to do quarterly taxation. And so you might have to do more accounting and bookkeeping and be ready for those quarterly taxes. So.
And Kate asked, how was the $11,000 allocated to Stevie? If Stevie isn't an owner, why does she get a dividend distribution?
Thank you. So Stevie didn't get that distribution. That money is just not being allocated to the members as surplus that you get the tax benefit from. So profits are taxed like regular profits because they're being generated from a non-member. And so Stevie doesn't get that money unless the cooperative decides that they want to treat their employees like cooperative members and give them some portion of the profits that they generated. But typically, the employees who are not members will not see the benefit of those profits. The profits are a lot of times put into the internal capital account or as operating capital for the cooperative itself. Thanks for that question. And I'll take one more and then we'll take a 5-minute break.
Sure. Daniel says, can an LLC operate as a cooperative and use the financial flows you've been talking about, including filing taxes?
Yes, that is such a good segue because that is what Greg is going to talk about. And the short answer is yes, LLCs can choose whatever. If LLCs want to be taxed as partnerships, if LLCs want to be taxed as a corporation or subchapter T, they can. So Greg is going to talk about that. So we're going to take a 5-minute break to give our Kirk, our ASL interpreter, a little break, and then we'll come back. And so we'll start promptly at 37 after the hour. Thanks, everybody. Just gonna throw on some music and chill out. Go grab some water. Go do your thing.
Cool. Thanks, Ricardo. I think my goal is to do this in 12 minutes. So hopefully by 12:50, we'll have walked through this. I'm going to do a micro training about the taxes under subchapters S, T, C, and K, taught by Cake. So this was created by Janelle Orsi, one of my colleagues at the Law Center. If you can go to the next slide. And while helping out a client, they were talking about how they were leaning towards forming a cooperative, but then someone was thinking about maybe a B Corp, another person's thinking about a C Corp, and then also figure out, like, should we just be simple about it and do an LLC? Janelle, in her infinite creativity, created this analogy to help us understand what that process is like. So we'll go to the next slide. So the state level entity choice that you'll be making, like a corporation or an LLC, etc., that's going to be the actual cake. The tax status that you choose will be the frosting you put on top of the cake. And before all of that even happens, like the financial governance and operational policies that you're mixing up, is what makes it special. So going to the next slide. So go past this one as well. We already know that cooperatives can be many things. Read about this.
Greg, you're cutting out. You might want to turn off your video.
Okay, sounds good. Okay, so so the entity choices for the cakes could be corporations or LLCs. The tax status, the icing on top, could be C Corp, T Corp, S Corp, etc. Moving on. I mean, if you want to look into like B Corps, that's pretty much the sprinkles on top of the cake. And the way that you create your financial governance operational policies will contribute to you being able to be certified as a B Corp. It's not really an entity choice. It's more of like a certification from an outside business. So into the next slide. The ABCs, or as Janelle says, the CKSTs of tax categories. The next slide, this is just for like information, show how many different kinds of subchapters there are underneath of normal taxes in the tax code. And then you can find like the different subchapters for exempt organizations like 501c3s, partnerships, corporations. The next slide, you'll find S Corps and T Corps, the cooperatives, within all of these other things. And the beauty about it is that you can match. So the cake that you're forming at the entity level, the sole proprietorships or LLCs, the partnerships or corporations, those can be mixed and matched with the icings. And we'll show you like first, like what the defaults are for the different cakes, and then how to mix them if you'd like. And so I think you have to hit the button one more time. So sole proprietors are going to default to the individual tax rules, and that's basically filing a Schedule C with your 1040. A partnership is going to default to Subchapter K, which is about pass-through. And there's a whole thing about that we'll talk about. And then corporations default to Chapter C unless you do something different, and we'll talk about that. And so if you are an LLC, a partnership, or well, pretty much an LLC or a partnership or a corporation, if you file form 8832, that will let the IRS know that you'd like taxed as a corporation rather than what the default may have been. With the next one, we'll see that if you want to be classified as a subchapter S, so the S Corps, the ones that have like the max of 100 shareholders, you would be filing form 2553, regardless of your entity choice, to opt into that. And the last one, if you are wanting to be a cooperative and be taxed underneath of subchapter T, you'll be filing forms 8832 and 1120C, depending on where you're at. So sole proprietors, as we said, they're going to be filing the Schedule C for their 1040 taxes every year. They're going to have to pay self-employment income in addition to income on their personal taxes. So that's about 15.3% right now. Going to the next slide. All other entities, you're going to be filing something else. And we'll briefly talk about what that something else is. So we can skip past this one. It's, well, to know that like within 75 days of the tax year, you'd like for the like switching to apply, you'll need to file these forms with the IRS. but I'll move forward for time. So in Subchapter K, which is the pass-through tax like a partnership, the LLCs are actual partnerships, limited liability partnerships. We'll move forward. You'll want to, well, some of the benefits is that the entity doesn't pay tax. There's no double tax here. So the actual, and you also might be able to avoid becoming an employee of the company because is that courts view ownership in the way the money pass through. You can also take some of those losses onto your personal taxes, which can help reduce your tax burden. But it's been often said by accountants that Subchapter K for this pass-through taxation can be very complex, and there's a need to be very what's the word for this? You want to be detail oriented, and as it says, allocating everything to profit and losses. We'll go to the next. Schedule K1 is what every person will be getting once you figure out where the profit and losses are going, and that's what you'll be filing to the IRS. And we're going to jump into like some of the corporate tax categories now. C, S, and T. Moving forward, a corporate tax status could make it appear and could make a court believe that you are viewed as an employee of your own company, which is something some folks don't like. Want to keep in mind if you're wanting to have a corporate tax status. Slide. And it's also difficult to pass through to shareholders on an annual basis losses. And that's something you'll want to work out with an accountant like Rye Financial, who will be here in the breakout session. To the next slide. So for Subchapter C corporations, we already talked about how like even if you're not like filing articles of incorporation for like a corporation in California, you can still opt in to being taxed as one. And on the next slide, we'll talk about some of the benefits and the disadvantages. One of them is double tax. And so that means that when the business receives income, it's going to have to pay income on those it's going to have to pay taxes on all of that income. And also if it distributes in the form of patronage, or excuse me, in the form of dividends, those are also going to be taxed. Which can be a disadvantage. And it could also be an advantage depending on where you're at in the tax bracket. The entity tax is about 20%, like the corporate tax rates. But you can make like salaries a deductible expense. We talked about how like folks are considered employees rather than owners. Another benefit is being able to choose your own tax year and lower tax rates on your income based on well, we'll go to the next slide because it'll help me illustrate why this is helpful. So the tax on dividends are typically around 20%. And so you can see that if you're making above like $85,000, like you might want to, some people often do want to figure out how to reduce the amount they're going to pay on that money they're receiving. So rather than paying like 32% on that money that's coming in the form of dividends, you would be paying around 20% and saving some money. To the next slide. A corporate tax status could also mean that you don't have to pay that what do we call this? Self-employment tax that we were talking about that breaks down into Medicare and Social Security. So when you're receiving your dividend, you'll just be, you'll be paying the tax, but not the unemployment tax. To the next slide. So if you are a shareholder of a C Corp, you can expect one of these 1099 divs in the mail. I got one of those for the first time this year. It was cool. We'll go to the next slide. Subchapter S for pass-through corporations. So if you have filed articles of incorporation as like a corporation here in California, or you're an LLC that wants to be treated something else, you can do this. Going to the next slide. So some of the requirements for if you'd like to have a S Corp, you have to have 100 or fewer shareholders. None of them can be corporate people. You have to deal with natural humans. Also, unfortunately, no like resident aliens as shareholders, so that may deter some folks. There's also only one class of stock. So that means that, yeah, I mean, in a good way sometimes, but not in a good way other times. Everyone's kind of like on the same level. This is a pass-through type of taxation. And so the S Corp won't be paying entity taxes, but the people who have shares will pay portions of the corporate tax relative to the amount of shares that they have. No double taxation on this one. You'll be getting a Schedule K1, similar to how we were talking about with the partnership election. And then the last one, Subchapter T, or the cooperative tax, is one where you can like mix and match. There'll be some taxes happening at the entity level. There could be some double tax if you choose to do it. I mean, you can also do pass-through. So there's a question, is this the best of both worlds? Some say yes. So you'll have to operate on a cooperative basis, like Ricardo was talking about earlier, primarily being democratic and equitable. There will be no double tax on the basis of patronage. And so if the cooperative makes money and is able to distribute that surplus, the co-op won't pay taxes on that revenue that's been distributed, but the folks who are receiving the money will pay some tax on that. If you wanted to distribute the profit that was created by non-members, then you can get the like dividend double taxation thing happening. And then what was the last one? Oh, and then for all, for the rest of the unallocated earnings, there'll be an entity level tax on that. You can expect a 1099 PATR if you are a member of a co-op getting some patronage. And I think this is the end maybe. And I surprisingly got through that in like 12 minutes.
Nice. Thank you very much. Greg, really appreciate it. Yeah, that's a lot. I forgot to remind folks at the beginning that we will be sharing these slides. So, and the recording.
Oh, Ricardo, I just checked. There are like 3 or 4 more slides. May I do those?
Yeah, sure.
Okay. Okay, so for LLCs, if you elect to be taxed as an LLC, that's pass through. In addition to paying like taxes as an individual, you'll also have to pay this like minimum franchise tax, and it also is dependent upon like how much money you're making every year. The next slide, I think it's like a summation. So Janelle summarized, like it often comes down to if people don't want to be employees of their own company, they'll be choosing Subchapter K, and then they'll be getting that like pass-through income. The next, but if someone wants to if there's a yearning to have unallocated accounts, it's difficult to do that with a pass-through entity, because regardless of if the entity is holding that money, the individual people are going to have to pay taxes on it. But if you're choosing like a Subchapter C or a Subchapter T entity tax level choice, then the individual members won't have to pay taxes on that. The business itself will have to, and that's often like helpful for folks not having that personal obligation. And then if you want lower tax rates on those individual or on those dividends, we already talked about how in C or T you can receive dividends in subchapter and in subchapter. It's a pass-through, not double taxation, so you can lower some tax all 3 of those ways. Cool. Thanks, Ricardo. And Ricardo, yeah, and cooperatives, we can have our cake and eat it too. Appreciate it.
Nice. Thank you very much, Greg. Really appreciate that. And thank you, Kirk, for valiantly keeping up with Greg. I'm going to pass it over to Kieran, who's going to talk a bit about Berkeley's support for worker cooperatives. And yeah. Kieran.
Thank you. Let me try again and see how we're looking this time. Can you see it? Good to go?
Good to go, yeah.
Cool. I realize I need more hand-drawn cartoon slides in my presentation. I like it. It's good stuff, you guys. You got to hook me up with whoever your sketch artist is. Just wanted to briefly introduce myself again. Kieran Slaughter, City of Berkeley. Wanted to just orient everybody to what Office of Economic Developments typically do. Some don't know what we do. So this is really just a quick snapshot of what our office provides our clients. And usually those are folks who are looking to establish business in the city of Berkeley or expand. And a lot of what we do is helping them navigate codes, help find places to get their business established or to get financing. This is our team. That's our mission statement. You know, we're really trying to make folks feel comfortable, feel welcome, and thrive. So a little history about the RLF, what we call the Revolving Loan Fund. It offers loans with attractive rates and terms. It's supposed to help small businesses expand by funding equipment, working capital, inventory, or real estate. It's really supposed to be a tool of economic development. And the true intent is to either create or to retain jobs. And so that's really our number one goal, create or retain jobs. Quick little loan fund 101 is probably the closest thing I have to a cartoon. We got a grant way back in 1980 for $500,000. We make loans to businesses with a small percentage rate, and we use the income that we generate from that percentage to revolve the loan fund and create more loans to other businesses in Berkeley. And we're not in it to make money, we're in it to make you money and to make others money by recirculating the loan funds. And so we have a small amount that we can use for marketing and administrative expenses, but typically our loan sizes are between $35,000 to $150,000. We have a requirement to use what the current prime rate is plus 2 points as our interest rates. Usually the terms are between 5 and 7 years. And the real reason people really enjoy it is because there's some flexibility and there's some human touch to it. So our loan administration board is what approves and modifies loans, and they're all working professionals in the city of Berkeley who have a vested interest in seeing businesses be successful. And so there's some flexibility there. You actually see them, and they're not often some far off place in the Midwest, and you have to try and hunt them down through a phone call or email. One of the reasons we're here is because we're happy to celebrate new regulations that SELC and Project Equity helped advocate for, and some folks on this call, which is to create new opportunities for worker-owned cooperatives through our loan fund. So that meant making some modifications to our plan. There's a plan that we have to report to the federal government on, and it requires the city council to approve the changes to those plans. And they did that. And so some of the changes is that it allows the use of loan capital for the conversion of worker-owned cooperatives. Sometimes that's an impediment to making that conversion. We also now allow a panel of workers or workers/owners to be the panel that provides the personal guarantee. So it's not all on one person, and it's not on everybody, but there can be a selection of 5 or 10 individuals, and people can rotate in and out of that if they leave the organization. It also includes the creation or retention of worker-owned jobs as a selection criteria. And we have a new goal to allocate 10% of our loan portfolios to cooperatives. So we're actively looking for another cooperative to fund. The other thing is that it allows us to have educational webinars for city staff and entrepreneurs. And every time I participate in one of these, I learn something new. And many of our city staff just aren't aware of the nuts and bolts of cooperatives. And it allows them to learn, what some of you guys are learning today. And I think that's really helpful to bridge the gap between the folks who are administering and providing funding to those who are seeking funding. Because if we're not speaking the same language, it creates a barrier. This is our snapshot of our loan administration board. Each one of our city council members gets to appoint one person. to the board to make these decisions. These are publicly noticed in public meetings that the public is welcome to come participate in. We rarely get public participation, but people are welcome to participate. Usually it's just the applicant, but it gives you a snapshot of who our board members are. And so just quickly give you an idea of what our looks like. This is a snapshot of who's received funding right now. It's a good cross section across the board. But our last cooperative to receive funding was a biofuel oasis, and we're looking to find another one to slot in there. And so as you can see, a range of total amount loaned and a range of interest rates, and as well as terms. And so some of you may have seen, if you're from the Bay Area, one of our newest recipients is Lila Owens with Cupcaking, and she's one of, I think, 4 Black-owned bakers in the city of Berkeley, in addition to Nabalom and Anthony's Cookies. But she opened up a new location. It was really expensive to convert the old Virginia bakery into a new state-of-the-art facility, but she did it. She used the loan fund to do that. We also have East Bay Media Center. We have Kitchen on Fire, which does cooking classes, Nabalom Bakery and Pizzeria, Slingfin, which makes high-end backpacking equipment, Minuteman Press, as well as a salon. And so we also do some marketing outreach. Typical stuff is flyers, our elected officials, word of mouth, webinars like this. But one of the things I want to, encourage you all to do is look and see if your local jurisdiction, if you're not here in the Bay Area, many people just aren't aware that their city actually provides funding and loan funds. And as a lot of us did realize, we also provided grants during the pandemic, and that was something that was pretty new, with the exception of arts grants. But several cities and several counties provide these types of loans, and if they don't, you should advocate for them to do that. And that could just be setting aside a little bit of seed money when it comes budget time to do this exact same thing. And they can start small with $10,000, $50,000, which is small in the city's budget, but big to you all. And those monies can be utilized and leveraged to help people convert to work on cooperatives. So that's something that we would highly encourage you all to do, to advocate for. And it doesn't take much. A couple meetings with council members, a couple examples of other revolving loan funds can be used. So real quick, the application process, it's pretty typical. I would say that the challenge with, and I have another slide that talks about the area, but just one of the challenges is we are a government. It does take a little bit longer to process some of these loans and paperwork. But the flip side is you get a really good rate and you get really cool terms. So it's worth the wait. You don't want to, move too quick and end up with a 10, 11, 13% rate on your loan. This is just a snapshot of the city of Berkeley. This fund started in South Berkeley to try and remedy some of the wrongs that were done back in the 60s and 70s when the BART station, which is our subway, plowed through a historically Black neighborhood. That was one of the hubs of economic development, and it was meant to try and remedy that. It was deemed too small of an area, so it expanded, and now it's citywide. So these are our assets and strengths. As I mentioned, you get the loan administration board that is generally interested in supporting you. The revolving loan fund you can leverage that with other resources. We have local control. We're not talking to some big bank. Good interest rates, but the weakness is a long period of time it takes to get through closing. Sometimes stuff can be cumbersome. We've tried to streamline it and make it really easy to apply. And this is just some of the things we've heard from borrowers, what they like: marketing ideas, visibility. They want help with business growth. They want technical assistance like what we're providing now. So it goes hand in hand with just providing capital. They really want that that nurturing, the support, the camaraderie of talking to other people in the same situation. And that closes out my portion of the presentation, and I will stop sharing now and turn it back over to Ricardo. Uh-oh, mute.
Thank you. No, I appreciate that. Thank you, Kieran. Really appreciate it. It's such vital information that that you're providing and inspiration to other cities around the country to start supporting worker cooperatives in tangible ways and finding ways to shift capital to the communities that need it most, who are generating the wealth in our businesses. So in a moment, we are going to have some breakout rooms. We're going to have a little bit under half an hour to chat. And so before I share the resources that we have available today, I want to invite our friends from who are going to be participating in those breakout rooms to introduce themselves. So I'll start with Laura Smoot. Smoot, you mind introducing yourself?
Sure, no problem. Hi, everybody. My name's Laura Smoot, and I've been working in worker cooperatives for about a decade. And maybe 5 or 6 years ago, I started working as a bookkeeper, and I'm now studying to become an accountant. So come to my breakout session if you want to talk about money or how it's going with money in your co-op.
Awesome. Thank you, Smoot.
Sure.
So Smoot will be in one breakout room, and then we'll have another breakout room with Kieran and Miyaka. So Miyaka, would you like to introduce yourself?
Hi, my name is Miyaka Cochran from Project Equity. I'm a business engagement manager, and what Project Equity does is help people learn about co-ops similarly to SELC, but we also have services for businesses who want to transition, going through feasibility and the nuts and bolts of how to make it happen.
Nice. Thank you, Miyaka. Okay, so I'm just going to share some resources that folks. Oh, yeah, Kieran.
Real quick, one other thing I just wanted to mention that could make it an easy sell for your local officials is it's really easy to make sort of the alignment between what a lot of your elected officials' values are with the benefits of funding worker-owned cooperatives. It's not a hard connection to make, which is why our city council was so adamant that they wanted to support this. So I just want to make sure you guys understand that it may seem like an impossible hurdle to start something like this, but in less than a year, I think if you're organized and if you're passionate, you can talk to a couple of your council members or city officials, city managers, and you can make the easy connection with the values of and the benefits of worker-owned cooperatives with the values that many of those elected officials represent. So I just want to make sure I threw that out there, and you can look to some of the resources from our mayor and what he's posted, and use those same talking points in your advocacy in your local jurisdiction.
Thank you, Kieran. Yeah, appreciate that. Yeah, so we'll have, after I share the resources, we'll open up the breakout rooms. You'll get to choose whether to go and talk with Kieran and Miyaka or talk with Smoot. And then we'll also open up a third breakout room with Gregory Jackson. So if you're here just wanting to talk co-ops and get into that. So Tia is sharing some resources in the chat as well. So City of Berkeley is an amazing resource, like Kieran was saying. Cooplaw.org is our online library of resources around cooperatives and the law. On there, you'll find our Think Outside the Box manual, which is our most comprehensive guide to starting and operating a worker-owned cooperative. We have our Resilient Communities Legal Cafes that happen 3 times per month. You can come and talk to us if you're in California. We can give you legal advice. And if you're outside of California, you can come and get legal information. So it's still useful. Project Equity is an amazing resource. If your business is looking to convert and sell to the employees, they can help steward that conversion process. And Miyaka can, if you're interested in that, please go to the breakout room with Miyaka. Democracy at Work Institute is the nonprofit arm of the U.S. Federation of Worker Cooperatives. And they provide lots of resources for worker cooperatives and policy advocacy, et cetera. There's also the California Cooperative Development Center, California Center for Cooperative Development, it's a typo, CCCD. And they do all different types of cooperatives, and the U.S. Federation of Worker Cooperatives. They're the National Business Association of Worker Cooperatives and Democratic Workplaces. And they're a great resource.